Have you ever wondered who's really in the driver's seat when it comes to the economy? Beyond the headlines about politicians or big corporations. Well, a huge piece of the puzzle is something called monetary policy. It's basically the toolkit a country's central bank uses to try and keep the economy humming along smoothly. But how does it actually work? Let's get into it. All right, so here's our game plan. We're going to start with a big challenge every economy faces. Then we'll look at the specific tools central banks use to tackle it. We'll see how they decide whether to hit the gas or pump the brakes, and trace how those decisions ripple out. We'll also cover the tricky situations where the tools don't quite work. And, most importantly, we'll connect all of this back to what it means for you and your money.
You see, at its heart, managing an economy is all about a super delicate balancing act. The goal is always to avoid two major problems that can really cause a lot of pain.
And honestly, the best way to picture it is like walking a tightrope. If you lean too far one way, you're going to fall. Too far the other way, same result, just a different kind of fall. So the central bank's job is to stay right in that sweet spot in the middle. But what exactly are they trying to balance? Well, on one side of the tightrope, you've got an economy that gets too hot. This leads straight to high inflation. And you felt this, right? It's when your dollar just doesn't stretch as far, and everything from gas to groceries gets more expensive. The goal there, cool things down. But on the other side, you have an economy that's too cold. That's when we get a recession. Businesses pull back, they stop hiring, people lose their jobs, and unemployment goes up. In that case, the goal is the exact opposite. You need to stimulate the economy and get it moving again.
So how in the world does a central bank actually walk this tightrope? Well, they're not just crossing their fingers. They have a very specific set of tools they can use to nudge the economy in one direction or the other.
Okay, so their main tools include things like open market operations, which is just a fancy way of saying they buy and sell government bonds, and reserve requirements, telling banks how much cash they need to keep on hand. But the big one, the one you always hear about on the news, is the official policy rate. In the US, you know it as the Fed funds rate. This is the main lever they pull, the interest rate they charge to other banks, and it's what sets the tone for the entire economy. So, using that main tool, the policy rate, really boils down to two basic moves. And the best way to think about it is like you're driving a car. You're either hitting the gas or you're hitting the brakes. So when the economy is too cold and we're worried about a recession, the central bank hits the gas. That's called expansionary policy. They cut the policy rate. Suddenly, it's cheaper to borrow money, so businesses start investing more, people feel more confident spending, and the whole economy gets a boost. But when the economy gets too hot and inflation starts creeping up, they hit the brakes. That's contractionary policy. They raise the policy interest rate. Now, borrowing is more expensive, which makes everyone think twice about spending, and that helps cool things down. So it's pretty straightforward. Lower rates to expand, higher rates to contract. Now, here's the thing. When a central bank changes that rate, it's not like flipping a switch where everything changes instantly. No, it's more like dropping a pebble into a pond. It starts a ripple effect that spreads far and wide through the whole financial system. This is what economists call the transmission mechanism. It all starts with that one change to the policy rate. Right away, other short-term interest rates react. Then, that starts to affect the prices of things like stocks and bonds, and even the value of the country's currency. But the final ripple, and this might be the most important one, is that it changes our expectations. You and me, businesses, we see what the central bank is doing and we start to think differently about the future, which changes how we spend and save today. That's what ultimately makes the policy work. But look, if it was really that easy, we'd never have high inflation or deep recessions, right? The truth is, these tools have some serious limitations. They don't always work like they're supposed to. Yeah, a few things can really throw a wrench in the works. Sometimes, especially in developing countries, the central bank just might not have the credibility or independence to pull it off. But here's a huge one. Even for major economies, you can't force a bank to lend money, and you can't force people to borrow it. You can make borrowing cheaper and cheaper, but if everyone's scared, the money just sits there. That's what's known as a liquidity trap. And this quote just hits the nail on the head. In tough times, central banks might try these unconventional policies, like creating a bunch of new money to buy up assets. But even then, if the commercial banks think the economy is too risky, they'll do exactly what the quote says. They'll just hold on to that cash instead of lending it out, because they're afraid people won't be able to pay it back. And that fear can stop the whole policy in its tracks. Okay, we've talked a lot of theory here. Central banks, policy rates, transmission mechanisms. So let's bring it all the way back home. Why should you actually care about any of this? Well, because these big, abstract decisions directly affect your bank account. It's really simple. Every time the central bank moves that policy rate up or down, the ripples eventually wash up on your shore. It directly influences the interest rate you'll pay for a mortgage on a new house or for a car loan. It changes how much or how little you earn on the money in your savings account. Understanding if policy is in gas mode or brake mode gives you a huge clue about the financial world you're operating in. So that leaves us with one big question to chew on. When you think about its incredible power, but also its very real limits, what is monetary policy, really? Is it a surgeon's scalpel, capable of these tiny, precise adjustments to keep everything perfectly in balance? Or is it more like a giant hammer, a powerful but sometimes clumsy tool that we use to whack a massive, complicated system in the right direction? The real answer, as always, is probably somewhere in the middle.